In addition to ratios using only balance sheet accounts, many financial ratios combine balance sheet accounts in comparison with the results reported on the income statement. Two turnover ratios are noteworthy: inventory turnover and a comparison between sales and capital fixed assets. Inventory turnover compares the average inventory for the year to the cost of goods sold for the entire period. In developing average inventory, the level of change during the year should dictate how it is calculated. For example, if the inventory levels remain fairly consistent throughout the entire year, a beginning and ending balance can be added and divided by 2. When levels change significantly depending on the calendar cycle, use either quarterly inventory levels or even monthly levels, depending on the degree of change. The ratio estimates the level of cash committed to maintaining required inventory levels, with the intention of indicating when levels should be reduced to improve cash flow. If the company is maintaining inventory at a higher level than required, it not only ties up cash, it is also spending too much money on transportation, insurance, property taxes, warehouse labor, record keeping, interest, and the danger of deterioration, damage, theft, and obsolescence. Keeping inventory turnover at a minimum required level based on sales volume for the season saves both cash flow and profits. And here is the formula: cost of goods sold divided by the beginning inventory added to the ending inventory divided by the number of periods in the average. Here is the example. A company has reported cost of goods sold for the past fiscal year of $6,500,735. The inventory level at the beginning of the year was $802,400 and at the end of the year was $945,678. Determine the inventory turnover. Let's see this on a spreadsheet. Here is the example: cost of goods sold, beginning inventory, ending inventory, and the number of periods, in this case 2. The formula: cost of goods sold divided by the sum of the beginning and ending inventory divided by 2, the number of periods, 7.44 times. The average inventory was turned replaced 7.44 times during the year. On average, the company maintains 1.5 months worth of inventory on hand. This calculation is valuable as a means of tracking inventory management. If the number of turns begins to decline, inventory levels are rising relative to the cost of goods sold. If levels of 1.5 months worth of goods are considered reasonable, a turnover rate below 7.44 times would be a negative trend.